Most people think the only way to pay a 30-year mortgage is to suffer for 30 years. But that's not true. There's different ways to pay off a mortgage. And in fact, ways you can pay off a 30-year mortgage faster and pay less interest. And in today's video, we're going to go through 8 different ways that you can do exactly that. It's different strategies and some of them combinations of strategies. And I can almost guarantee that the last one is really going to blow your mind. My name is Aaron Revere, and I'm a wealth strategist. And what that means is I help save people from costly investments and help them save money on their borrowing, their insurance, and their taxes. And if you're interested in doing one of those things, information how you can reach me is in the description of the video. Without further delay, let's get into the strategies. Again, the 8th one, you're going to dramatically save 6 figures in interest. Let's dig in. So first things first, let's establish the baseline here. So here we've got somebody, they've got a brand new mortgage at 6%, right? And they have a $500,000 mortgage balance. Now, when you do the amortization calculator, you'll figure out that they're going to have a $3,000 a month payment. That doesn't include the taxes and insurance, right? That's just the principal and interest. Now, it doesn't take a lot of math to figure out that if you multiply that by 12 months, you're going to get $36,000 in payments. However, unfortunately, at the end of year one, your balance, right? This is year one. Your balance is going to be $493,000. So you spent $36,000 on your payment. However, you only peeled off the principal by about $7,000, right? Only $7,000 of the 36 went towards your principal. That's not obviously very nice. And so that's why we're going to talk about strategies to do better, right? Now, let's make sure we're kind of looking at all these the same. I'm always going to show you the amount of time it takes. So this is obviously a 30-year mortgage. And I'm going to show you the interest or the interest saved. So just for our baseline here, this mortgage, when you pay it, you're going to end up paying $579,000 in interest. Okay, so just to be clear, this is the $500,000 you borrow. You're going to pay that back, plus you're going to pay this back, the $579,000. I shouldn't say pay back. You're going to pay that as interest. It's basically a fee to the bank for lending you the money. So you're going to pay $579,000 besides for paying back the $500,000 over here. Okay. Now, just to make some apples to apples comparisons, I have also put over here that this person has $50,000 in savings. This is after closing, and they make $20,000 left over at the end of each year, meaning that their income, right, minus their expenses equals this $20,000 left over at the end of the year. Now, these numbers are just for simplicity's sake. With other numbers, these different systems will still work, but I'm just trying to use easy numbers because this is obviously 10% of the loan, and this is $20,000. So that's 20% of $100,000, and $100,000 is 20% of this loan balance. So I'm just trying to make it for easy numbers, and because as we go on, we're going to use some of this for comparing what if I invest this $50,000 and what if I continuously invest this $20,000 left over at the end of the year. Do I understand that not everyone, in fact, this is a very nice financial picture? Yes, I totally get that. Again, these are just numbers for simplicity and illustrative purposes. A lot of these techniques will definitely work with different numbers, but you're welcome, of course, to put that through your own calculator. So now let's look at the most basic idea. We could take this $50,000 that's sitting in savings. Let's just say it happened that right after the closing, Aunt Gertrude died and she left you $50,000 tax-free and a life insurance policy. Well, that $50,000, should you decide, can go over here to your mortgage. Okay, now let's see what that looks like. So you had $500,000 balance on your mortgage. Now you got $50,000 that you put towards your principal. Your new principal is $450,000. Now, let me ask you this quick question before we get into what you do gain from this. Do you think that you gain a lower payment from this? Do you get a lower payment by sending that $50,000 to your bank? The answer, unfortunately, is no. And the reason for that is because it is contractual how much that your monthly payment's going to be. It's going to be $3,000 no matter what. I say no matter what, but actually in the next strategy we're going to see there is one thing you could do. But let's stick with this one first. What do you get? Well, your 30-year mortgage is going to turn into a 23 and some change year mortgage. So you definitely gain something. You peeled off 7 years from the loan. And once you start saving time on the loan, you'll see that you also save interest. So the interest savings on this, you end up paying because you are doing the 23 years in some months, you're going to end up paying $384,000. Okay. So before you were going to pay 579, I'm just going to round up. You were going to pay 579,000. Now you're going to end up paying 384,000. Let's look at the savings. The savings is $194,000. That's how much you saved by sending the $50,000 to your bank. You did not get a lower payment, right? But what you did get was you're going to pay off this loan faster, and you're saving this $194,000. Now, one more thing before I move on to the next strategy. A lot of people can certainly understand that they got this $50,000 over here, and if it's just sitting in their savings account, it's really not doing much for them. It would be better off over here. However, the people I speak with, besides for being unhappy of not getting a lower payment, they also mentioned the reason they don't send this $50,000 over here is because once it's over here in your mortgage, it's basically in your bank's bank account. And if you want access to that money, it's not so simple. You could certainly sell the house and you could get this additional equity payment back, so long as the house hasn't gone down in value. But a lot of people, when they, let's say, have a rainy day and they want this $50,000, they're not looking to sell the house. They're just looking to deal with their problem, right? So the other way to get this money out is you could do a cash out refinance, and that way you could get the money out. But if your rainy day issue is because you've lost your job, let's just say, then it's not going to be very easy to qualify for a new mortgage and get that $50,000 back. So for that reason, a lot of people, even though they can understand that there's interest savings here, etc., they like to keep this $50,000 right here in their savings account in case of a rainy day. So they don't even get the benefit of having this $50,000 doing anything towards their mortgage. They just keep it just in case. And there's nothing wrong with that. I can certainly understand that. But that's why they don't end up doing that strategy. Now, remember I said that there's one way that you could do something that when you do send this $50,000 to your bank, you could get a lower payment. Let's explore that right now. That is something called a recast. So if you send this $50,000 over here to your mortgage, you can call the bank and you can say, hey, look at me. I sent this $50,000. I've now paid off my balance by 10%. That's a significant principal payment. And I've got $450,000 balance now. I want you guys to do a recast, figure out what my payment should be based on my brand new balance. This has some advantages, some disadvantages. Obviously, we're going to get into it right here, right now. The first advantage is that, guess what I get? I get a lower payment. So before, where I was at a $3,000 a month payment, now I'm going to move to a $2,700 a month payment. All right, so that's nice. So I am saving $300 in positive cash flow is now mine. And I mean, that's nice. Who doesn't want more money in their pocket? But at what cost? So when you do this, you have to understand something about recasting is that the bank is basically looking at your new principal balance over here. I wrote it off already. Your $450, right? They're looking at that $450 and they're rescheduling it on a 30-year mortgage again. So what happens is that your $450,000 gets spread over 30 years. And so you have not shortened your time at all on this. So your 30-year mortgage stays a 30-year mortgage. Remember, before sending the $50,000, you moved it to about a 23-year mortgage. So to get that $300 in positive cash flow, you said goodbye to a shorter timeline for paying off your mortgage. Okay, well, what else? Let's look at like the total interest savings. That's got to be something, right? The total interest savings on this, so like we said, trying to keep them all apples to apples, 30 years, and we stay on 30 years. Okay, so what do we get? We do get some interest savings. The interest savings, though, is $57,900. Okay, so it's not super duper exciting. Remember, before we had a bigger interest savings of $194,000 by making that one-time $50,000 payment, but not doing the recast. By doing the recast, we have stayed on the 30-year plan, basically, and we have reduced our interest savings so that we could enjoy $300 more a month. Now, I don't know about you. That doesn't seem super exciting to me, but hey, to each their own. If in a certain situation, I could certainly understand why someone would want to do that. Now, the disadvantages of this, I mean, we've gone through again, a few of them, but just to remind everyone that when this $50,000 is in here, reducing this balance to 450, again, that money is in your bank's bank account. So if you want that money out, you got to sell the house again, or you got to look at doing a cash out refinance again. That even if you can qualify for that, that's fine, but it may come with fees and points, and it's not nothing of a process. Get ready to hand over your tax returns, or at least bank statements, right? So there you go. That is our third option. That was our third option, which is to do a recast when you send a 10% payment or so. Now, one last thing I forgot. You cannot recast on FHA loans, VA loans, or USDA loans. However, if you have a conventional mortgage, then most banks, not all, most banks for a small fee will let you do a recast. Okay, so if your bank is, I don't know, Wells Fargo, Bank of America, City National, Citibank, who else? Most all the credit unions, Navy Federal, they will let you do a recast, usually for a small fee. And like we've talked about already, you know what you're getting. So far the strategies we've talked about have basically been using this $50,000 to try and affect the timeline or the interest that's going to be charged on this mortgage. Now, strategy number 4, we are going to take a different route this time. We're going to talk about something you may have seen discussed on the internet, TikTok, or Instagram maybe, and this is something called biweekly payments, okay? And biweekly payments, they are what they sound like. What you're going to do basically is instead of making one monthly payment, you're going to divide that one monthly payment and you're going to pay that every 2 weeks. So basically, you're going to end up making 26 payments in a year. Okay, so 26 half payments. Now, that comes out, if you do the math, you figure out that instead of 12 payments, which is what you're doing, you end up making 13 payments, right? Because you had 26 payments. Each one was a half of what your old $3,000 a month payment was. Now it's 26 payments, right, at $1,500, okay? You're going to end up paying 13 payments. You're going to end up sending one extra $3,000 to the bank every year. Now, we're going to discuss this a little later, but to keep this honest, just to show you, this $20,000 that I'm saying this person's saving at the end of the year, once they're doing biweekly payments, really they're saving $17K at the end of the year. We're going to get into that a little later when we start doing some investing and looking how that affects our mortgage. So this person is making 13 payments a year, or excuse me, 13 full payments a year, right? Let's look at what simply doing that means for our mortgage. So the timing, we go from a 30-year mortgage to a 24.5-year mortgage. Those extra payments that we send, that 13th payment that we send every year, that adds up. It goes towards principal and it peels 6.5 years off the mortgage, 5.5. Now, what we do next is we go to the interest savings. The interest savings on this, you end up spending still $455,000. Remember doing it the old-fashioned way over here, the 6% traditional mortgage, you're going to spend $579,000. So basically your interest savings is $124,000. That is certainly significant. It's not quite as good as making that one-time $50,000 payment to your bank. However, this does keep this $50,000 here in our bank account, and we don't have to say goodbye to it and then risk, of course, the rainy day situation where suddenly we need this $50,000, but we don't have access to it without calling the bank. We don't want that. So pretty darn good interest savings without having to touch the $50,000. Now, I just want to quickly come here to Bankrate and just show you that they have a little handy-dandy biweekly mortgage calculator. So we put in our $500,000 at our 6% interest rate, 30 years of mortgage. And when we calculate that, you could see it shows you, what's nice about this, they show you the side-by-side, right? So the monthly payment was $2,997. I've been rounding that to $3,000 for our examples, right? They show you the total interest that you're going to end up paying over the long term and the average interest in each month. And then they compare that with the biweekly payment. So like we said, it's basically half of your monthly mortgage payment, but you're making it every 2 weeks. You end up saving, right? This is where you get your interest savings because you only spent $450 as opposed to spending $579. And a nice little thing I like here is that you can hit the amortization table and they show you year by year how you compare. So 5 years in, you can see by doing this biweekly system, you almost have $20,000 of additional equity. Let's go, I don't know, let's go 15 years in, halfway through the mortgage. Traditionally, you'd be at 355. Doing the biweekly, you're at 280,000. So I just thought that was a nice feature that Bankrate has in their calculator, and I thought I'd share that. Now let's look at this situation. So we talked about before how this person's making about a $3,000 a month payment. What if we do from this money that's left over at the end of the year, what if we do more than a 50% bump in that monthly payment? In fact, let's take this monthly, which is about $1,667. All right, let's send that money as extra principal payment to our bank, right? This is obviously a pretty basic idea, but let's see where that puts us. Again, that $20,000 at the end of the year that was in our bank account now is going to be in our bank's bank account, but let's see what that does for us. At the end of the year, your 30-year mortgage at the end of the day is going to be a 12-year and basically 10-month mortgage, and you're going to save $361,000 in interest. So certainly very good interest savings. Can't deny that that's pretty exciting. Of course, and hold on, the timing is also great. It's a 12-year mortgage instead of a 30-year mortgage. The issues I have with this, if anyone ever mentions this to me, I mean, this is nice, but very hypothetical, because if a person can afford a $3,000 a month payment, but actually they could afford to send an additional $1,600 a month, I'm not so sure they got this house, right? If they had so much extra spending power they're willing to use this extra spending power per month, I'm not so convinced that they wouldn't just get a bigger house. But let's even just say that someone's going to live simply, right? That this is all the house they need. They're so happy with it, and they're willing to not make a $4,600 a month payment every month, of which $3,000 includes principal and interest, and then this the difference here, right? This difference here, is all principal. This is nice and all, but still we're giving up that $20,000 a year every year for 12 years. All that money that otherwise would have accumulated here, we're saying goodbye to that access, goodbye to that liquidity, and sending it over here to the mortgage. I don't think that a lot of people are interested in doing that, but it's nice for all of our comparison uses over here, nice to see what the timeline and the interest savings are in that case. Now, let's talk about using this $50,000, but not sending it off to the mortgage. No, instead, we are going to talk about investing it with the idea, for right now anyhow, of taking that money, investing it, and then getting a rate of return, and over a period of time, suddenly, maybe 10, 15 years in the future, we're going to have so much money in our investment account that we're going to be able to make a one-time final payment, goodbye to the mortgage, and completely wipe it out. So let's explore that. So let's take this $50,000 and let's do that. Let's send it to an investment. Now, let's just say, for example, someone invests in the S&P 500 and they're expecting the 10% annual returns, which is the long-term annual rate of return for the S&P 500, right? A lot of times people will ask me, hey, why should I pay off, let's say, a 6% mortgage? Why should I pay off a 6% mortgage when I can earn 10% in the market? And that's not a bad question, certainly valid. I mean, there's a couple things to consider. One, it's not a guaranteed 10%, right? You could certainly have some bad years. You might underperform the market, just, bad luck kind of a thing. But I can certainly appreciate that 10% is the long-term average, right? So let's explore that. Let's explore taking that long-term average and assuming that we're just going to get it. We're just going to assume I'm going to get it like clockwork. So $50,000 at 10%. For how many years is the question, until I can one fell swoop make one gigantic payment to this mortgage? So I got the numbers here on my other screen, and here's what they are. So we're just taking the $50,000. We're investing at 10%, like I've said. There's one thing we have to take into account. I'm assuming for these numbers that this $50,000 is after-tax money. However, the gain that I'm going to make earning that 10%, right? I'm going to buy a basket of stocks today. I'm not going to sell it until someday in the future when I'm ready to pay off this mortgage. And I will have to pay, though, a long-term capital gains tax of 20% when that day comes. So I'm taking into account the taxes. A lot of people forget to do that. And we'll talk about, well, wait a minute, I'll do it in my 401k and then I'll just eat the penalty if I can pay off sooner than 59 and a half. Let's not go there just yet. Let's stick to this, okay? So what happens is with this structure, let's see how long are you going to do it. You were at 30 years turns into, what do you think? Turns into just over 20 years investing that money, that 50,000 at 10%, and then the interest saved, you still spend $493 because 20 years later you're able to pay off this mortgage, but the interest paid, believe it or not, is still, the interest saved is only 85,000 and some change. So you didn't save a whole lot of interest. Now, I like that you paid it off sooner. I definitely like that part. The interest savings is not so fantastic. I know, it's a shame. At that point, you have to understand that because of the mortgages, the way they're structured is all that interest is loaded to the front. So the sooner you pay off your mortgage, if you could do it magically in year, 10 or 11, there's huge interest savings. But if you're paying off the mortgage in year 20, 23, 24, you're basically eliminating the need for the principal payment going forward. Mostly, there's definitely still some interest, but the bank has already gotten their fee for the most part. That's why the interest savings is not as hot as you might think. Okay, so now let's talk about strategy number 6. It's going to combine what we were just looking at and something we've done before. Let's take this $50,000 and let's invest it, like we said, into that 10%, like clockwork, rate of return, okay? And let's do that for X amount of years. But at the same time, we're going to take some of this $20,000 in positive cash flow every year. We're going to do a bi-weekly payment on our mortgage because we see how that has been beneficial. Let's switch our mortgage payment to bi-weekly. This $20,000 a year is going to become $17,000 a year because I'm making one extra payment. But let's just say someone's saying, hey, I'm willing to do that. I don't need to quite save so much money every year. And now I'm going to combine that with moving this $50,000 into the investment account. What do I get? So let's take a look at that. The numbers, as I have them here on the other page, is when you do that, you're going to pay off your mortgage. It's faster than simply investing the $50,000. The biweekly helps. Your 30-year mortgage becomes about a 17 and that's about 9 months or so. It's about a 17-year, 9-month mortgage. We're certainly making some progress. We've moved quite a bit away from a 30-year mortgage. And we're also able to enjoy some interest savings, in this case, of $169,000. That's certainly better than simply investing the $50,000 without doing the biweekly payments. Yes, the biweekly payments hurts my annual cash flow a little bit, but hey, it was worth it, or at least it will be worth it for a lot of people, to say they saved a significant amount of money. And let's not overlook the 17 years and 9 months. You signed up for a 30-year mortgage, or at least this person did when they signed up this loan, right? They signed up for a 30-year mortgage, and now they're able to pay it off in under 18 years. Having a paid-off house in under 18 years, first of all, that could be really good for retirement. And then think about all the equity in your house. You could use that for the next grand investment, or maybe a down payment on a vacation home, or a purchase of a business. It's certainly a good thing to have, and you don't have to just keep making that payment potentially into retirement years. 17 and a half or 17 years and 9 months, certainly better than 30. So this was strategy number 6. I certainly like it because we're starting to combine ideas. We combined it bi-weekly, and we combined that with investing this $50,000 at a 10% rate of return. Let's see if we can do any better. Okay, so now we're going to look at strategy number 7. It's going to be actually a combination of a few strategies. We'll see how we can kind of combine a few ideas we've gone through so far. They kind of leave you with a very similar result, so I'm just kind of grouping them all into one group of, strategy 7. So here we go. What we're going to do in this case is we're going to, let's start with, why don't we start this? We're going to take $50,000 and we're going to send that to our mortgage, okay? And besides for that, though, this person's going all out. They don't want any money left over for, the finer things of life, the cruises, the trips to Disney World. They're going to take this $20,000 and they are going to invest that money, and they're going to get, again, that 10% rate of return. And again, we're assuming just like clockwork, and they're going to do that. Okay, so what happens then? They take the $50,000 again towards the bank. They invest the $20,000 every year. Well, realistically, every month. I am doing the compounding monthly. I believe my math is right. And so let's see what that turns into on the board here. So that comes out to, this is the best so far. We're going from 30 years to almost just short of 10 years and about 5 months. So that is pretty nice. We've significantly shortened this mortgage. The interest savings, by the way, in this case are $333,884. Let's not get into that. $333,000. And again, I'm taking into account that the $50,000, excuse me, the $20,000, that is invested at the very end of all this. We do have to pay the long-term capital gains rate of 20%. Okay, can't forget that in your calculations. So that's pretty good. Now, I told you a few of these strategies are going to kind of be very similar to each other. Let's say you don't want to send the $50,000 to the mortgage, and you say, no, I want to invest that $50,000 together with the $20,000. Okay, so let's do that scenario. Well, in that case, I can tell you that the math comes out pretty similar. You're going to take your 30-year mortgage, turn it into a 10-year mortgage, almost to the dot, and your interest savings are going to be $301,000 in interest savings. Again, you didn't make any principal payment to the loan, so you didn't affect that early on interest in any way. So that's actually why the interest savings is not quite as good as it was before. Okay, last variation, just quickly. What if instead I take my $50,000 and I put that towards the principal, like we talked about before, okay, and I do a recast. Okay, so I gain $300, like we talked about before. I gain $300 in monthly cash flow, right? And that $300 that I gain in monthly cash flow, I put into this. So instead of having $20,000 at the end of the year, I have another $300 every month times 12 months. I have $3,600. So I have $23,000, okay, $23,600. That is what I have to invest in the market. And then again, one fall swoop, once it reaches my mortgage balance, I'm going to pay it off. What does that look like? That looks like this. You're going to pay off your 30-year mortgage in 10 and a quarter year. Okay, so let's call it 3 months, right? 10 years, 3 months, and you're going to save $323, wow, my rating's so bad, $323,000 in interest. Okay, so pretty close to the first strategy. If you just want to know which one was the king of them all, so far it was the first one we went through. So that was $50,000 towards the principal, not doing a recast, and investing $20,000 a year at 10%. This is really pretty good. Huge interest savings, can't be denied. And we got down to a 10-year mortgage. That certainly beats a 30-year mortgage. Now, is there a better way? Well, there's still one strategy left that I think you should take a look at. All right, here we go. Now, this strategy I'm a bit partial to because to me, it seems like the best. This is called the MFL system, and MFL stands for mortgage-free life, and it is a system that has a banking component to it, and that's obviously what we're going to talk about here, and it's meant to help you be mortgage-free sooner. So let's see what that looks like. Now, in all the examples, I have this wall up between the banking world and the mortgage. That's because these live in two separate worlds, right? My $50,000 over here doesn't do anything to my mortgage over here unless I send the money over in a principal payment or something like that. Okay, so now let's talk about MFL and how it's different. See, what MFL does is it gets rid of this wall. And so what ends up happening is we get a sort of all-in-one account between these three things. Your mortgage, your checking, and your savings all become one. So let's see how that looks when you put it all together. So over here on the mortgage balance, we're going to get the benefit right away of my $50,000 in savings. That's over here, right? It's going to all be in one. These are all together. So I get the benefit of that $50,000. So right away, my balance is $450,000. Furthermore, because the MFL loan is trying to help you pay off your mortgage, it's looking at what your balance is constantly. Average daily balance is figured out. And then because in this case that $50,000 went towards the principal, basically by being in this all-in-one account, right away you're going to get the benefit of a lower payment next month. Now, what about the $20,000 a year? What about that as well? This person is basically saving up about $1,600, a little bit more, $1,600 a month, $20,000 a year. Every month that they save that $1,600, they're bringing their payment down a little bit. Next month, they bring it down a little bit more. The idea, of course, is that they bring it down, 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 till eventually they have no loan payment at all. They've paid off the loan. Now, I also have said that people generally, I find, are a little scared to send their money over to from their savings account to their mortgage because they're worried if they need that money for a rainy day, what's going to happen if it's in the bank's bank account? It's not easy to get. The nice thing about the all-in-one sort of style of account that we have with MFL is that this money is not locked up. And should you need it, you can move it over here to your savings or checking, whatever you want. And then from there, you could write a check. And if, let's say, you lost your job and you needed to have a hold of that cash to pay for groceries and maybe, car expenses, or maybe there was a car accident and you needed money towards an accident deductible, right? You have the money for that. The only thing that's going to happen is, the share of your payment that was reduced because you had that $50,000 in the all-in-one kind of account, that's going to disappear, okay? But as you get back on your feet, first of all, you have this positive cash flow. It's certainly important. That $20,000 left over a year is going to help you lower that payment, lower that payment, lower that payment. If, let's say, life threw you a curveball and you needed that $50,000 and you had to take it out of the MFL system, the good news is you're still going to be okay with your positive cash flow. And let's just say if you were going to pay off your mortgage in, 8 years, now it's going to be maybe 9 years, right? Maybe 9.5, but you're still going to pay off your loan significantly faster. Oh, that brings me to obviously the main point. What are the numbers on this MFL system? How does it stack up with the other strategies that we've talked about so far? So the MFL system is going to take your 30-year mortgage and it converts it, and I'm using these same numbers, the first person with the $50,000 and $20,000 left over at the end of the year, this person is going to pay off their mortgage in 8.25 years. And this person is going to save $390,000. I'm rounding up 250. They're going to save $390,000. So I'm a little impartial to it because this is the fastest payoff that we've seen so far. And this is the greatest interest savings that we've seen so far. And what did we have to do? Did we have to invest this money and subject it to the market? Maybe we don't get that 10% rate of return like we were hoping on, that we would work out like clockwork. Nope. Did we have to say to this $20,000 that I'm also sticking it into the market every year and living Spartan and hoping that I get that 10% every year? No. All I did was I got smarter about how I'm banking. And I structured my money in a smarter, better way. Still have access to all this money should I need it for any emergencies. And without having to be subject to the whims of the market, I'm paying off my mortgage faster than any other strategies and saving the most interest. Imagine for a moment if you just got a 30-year mortgage and you see that you're going to be on the road to pay this thing off in 8.25 years. Now imagine you're there. You've paid off your mortgage. It's 8 years, 3 months later, and you have a fully paid off house that when you bought it was worth $650. Maybe 8 years from now, it's worth $750. And all that $750 is yours. No more mortgage payment. So now you don't have to eat a $3,000 a month payment every month. It's been going down steadily every month because of the MFL system. So your cash flow has been getting improved all the while. And then at the end of the 8 and 3 months years, you're left with a house that's valued at maybe $750. And all of that is your equity. It could really change somebody's life. So there you have it. 8 different strategies to pay off a mortgage faster. No, you don't have to sign up for 30 years of suffering. And some of these are pretty easy to implement, and some of them obviously take a little bit more effort and a little bit more financial discipline, but are obviously very, very well worth it. Now, to figure out if you qualify for the MFL system, I need 9 basic data points, stuff like what state is the property in, how old are you, what's the current mortgage payments, what's the balance, what's the home value, stuff like that. What's the income, what's the expenses every month, right? Because we're looking for positive cash flow. And if you want to reach out to me and see if you qualify, you can find my contact info in the description below. Now, wait a minute, maybe you have this question. How about just pay the mortgage for 30 years, regular, and then take all that extra money we had and invest it into the market, 10% compounded for 30 years? That's going to be a boatload of money. Why don't we just do that? Forget even paying off the mortgage. If you're interested in that, we do a deep dive in this other video. Check it out.